Welcome to Berman's Call. We are here to take your questions on both stocks and ETFs today. You can reach us toll free at 1-855-326-6266, or you can email us at bermanscall@bnnbloomberg.ca. And Larry Berman, of course, joining us now. We want to kick off, I believe, with geopolitics, geopolitical risks. I'm wondering kind of what opportunities you see, Larry, amongst all the geopolitical factors that are kind of influencing markets right now.
You know, when you get these types of shocks, it always presents dislocations in markets. And, you know, a couple of weeks ago in the educational segment, we talked about some of the areas that were being dislocated. For example, what I think is more of a short-term temporary rise in yields because of the inflation pressures that are building related to rising oil prices. So if this is going to be more permanent, which I don't think it is, then, you know, very justified. But if you think a slowing economy is coming around the bend, then a rise in yields is an opportunity to add some duration to your bond portfolio. So it's things like that we look for. The spike in oil prices obviously pushing energy markets higher. I don't believe that's long-term sustainable. So you actually want to be selling and taking profits into some of that dislocation that otherwise, when it normalizes, you know, a lot of these energy stocks that have had good rallies come back to earth.
Why don't you believe that's going to be sustainable long term, these high oil prices that we're seeing right now, given so much of the infrastructure is so damaged in the Middle East right now?
Yeah, so it's an excellent question. The answer is I don't know, and I wish I did know with precision, right? So it's a wager, if you will, on probability outcome. It's remarkable how quick some of these things can come back on. Sometimes they can reverse a pipeline and get equal distribution in other areas. So I'm not sure we're getting clear information these days. We are getting lots of headlines. There's definitely been a shock, and it's of a magnitude worse than expected, without a doubt. But to think that these things aren't going to be reversed in due course, I think is a naive assumption.
Right. Okay, so let's move on. There's something else that I know we want to get to today, and that's U.S. job numbers. Despite a holiday on Friday, they're still poised to come out on Friday. Anything you're watching for in particular, or what are you anticipating in terms of job growth?
Yeah, I put together a chart here, and I'm not sure if we can display it or not. But if you look back a couple of years here, you see all these different color-coded graphs. Right around the middle there is the zero line. And if you look at the sectors of the U.S. economy that are adding jobs and the sectors that are subtracting jobs, you see that big bright green bar there. And that is leisure and hospitality. And sorry, not leisure and hospitality, that is healthcare services by and large. And if you exclude that, there's actually job loss growth in the US for the last 2 years. So there's really only one sector that has been persistent because of the aging demographic, where healthcare workers are in demand. Most other sectors right now are seeing flat or net job declines. And that's pretty important. The other area there in purple, which is leisure and hospitality, has also turned the corner, which was a leadership area of adding jobs, is now flat or subtracting jobs. So I think, you know, you've got a U.S. labor situation that's very tentative, and you're getting you haven't seen mass layoffs yet. That's the next part of the cycle that I'd be very worried about. I don't think it's coming this year, but at some point in the not too distant future, I think that starts to broaden out. If we start to see persistent oil prices, to your point before, that could be a catalyst for some job layoffs as companies try to right size to prepare for higher costs.
And if we're seeing those softer numbers coming out of the U.S., I'm sure eventually, I take your point, maybe not layoffs coming this time around, but there is a trickle down effect, right? Especially if it happens in the U.S., there's sometimes a trickle down effect globally.
Well, as we say, what Big Brother does down in the States, and when the U.S. catches a cold, Canada gets a fever. So there's definitely knock-on effects. The fact that this is a positive in terms of energy prices up, temporary as it might be, to Canada, because we're a big exporter of energy, turns out to be a bit of a plus. But by and large, the Canadian jobs picture isn't robust at this point either in the cycle.
Okay, we'll take a quick break right now. Coming up next, though, we will get to your phone calls and your emails. Here's the number again on your screen. There's still time to give us a call with your questions on ETFs and large cap stocks. We'll be back in a moment. Welcome back to Berman's Call. We are here with Larry Berman, of course, and we're going to go straight to some viewer questions, Larry. So this first one is an email coming in from Gajanan, and it reads, may I know your thoughts on ZGROTT series ETF from BMO, which pays targeted 6% yield for retirees? Thank you. What are your thoughts on this ETF?
Yeah, when you look at ZGRO, it's predominantly a growth strategy, about 80% equities and 20% fixed income. So you say, well, how does something like that pay out 6% if none of the underlying securities pay out that much? You're getting a return of capital. So these ETFs are tax structure, basically, where you're getting back some of your own money, so you're getting a return of capital. It adjusts your cost base and ultimately gives you a better current cash flow, but a deferred tax bill. So is that appropriate for an individual? And that's a question between you. If you're a do-it-yourselfer, you got to figure that out yourself. Or if you're looking at tax advice from an accountant, ask them if that's appropriate for you. In many cases, when it comes to tax, I'm not a tax expert by any stretch of the imagination, but those are the dynamics you got to deal with. So you're either capable of doing that analysis yourself, or you're consulting someone for a fee to give you that advice on a personal basis. And without knowing great detail about a person's tax circumstances, have no idea if that's appropriate or not.
Okay, we're going to go to the phone lines now. Philip is calling in from Montreal with a question. Hi, Philip.
Hi. I wanted to ask Larry, I'm in my mid-30s working, and I wanted to start putting money aside. And I wanted to know what ETF he would recommend for somebody my age who just wants to start getting into the stock market, but with what's going on now with the Iran situation, the tariffs and everything, would a dividend ETF be the safest way to go?
Okay, thanks for your question.
Yeah, so typically Canada's 3% of the world. So if you think about dividends and you're thinking about a world index or global exposure, you're going to get unfavorable tax treatment from loading up on dividends because you've got that foreign withholding that comes into it. Typically, dividends are more mature companies and a bit less sensitive to market risk. But if you're in your 30s and your horizon for using this money is 30 plus years before you start withdrawing it to live off of, dividends isn't something you should be focused on. It's typically going to be a lot more growth oriented. So low cost global ETF, in Canada here, there's Vanguard who has some solutions. There's BMO who has some low cost global solutions like that ZGRO, for example. And then in the U.S., if you're trading in U.S. dollars, I love VT. For 7 basis points, you basically get every stock in the world. And if you dollar cost average something like that, it would be very, very interesting. But that would be for someone who's going to use U.S. dollars and trade in New York. So in Canada, you'd look at one of the Canadian growth ETFs. ZEQT is a great example of something that would work for someone who's fairly young and has a long-term horizon. But the question is always, can you handle the volatility? Almost everybody should have 100% equity exposure if you're young in the long run. Creating balance with fixed income in portfolios, to me, is not an ideal situation in the world we live in, where we do have to care about inflation and we do have to care about government debt loads in the world, where bonds aren't going to typically be the protection that historically they have been for people.
Okay, thanks for that. We're going to go back to the phone lines. Renata is calling in from Oakville with a question. Hi there. What's your question?
Hi, good afternoon to you both. Larry, I'd like your opinion on ZWU, what you think of it going forward, and I'll hang up and look forward to your opinion. Thank you so much.
Okay, thank you. ZWU, what do you think?
Yeah, I've been recommending this ETF for years and years and years for the people that are looking for tax-efficient dividends coming out of Canada in a diversified manner. And so it's got exposure to utilities, it's got exposure to pipelines, it's got exposure to the telcos. And it does so with a covered call overlay. So you got a lot of tax efficiency here. It's throwing off a yield north of 7%. And it's not a fixed income replacement because it's equity market risk. It's a lot more bond-like in its kind of yield component that is better than fixed income. So you've got tax efficiency, you've got lower risk overall, and you've got diversification. I think it's a winner for most investors.
Okay. Andy is calling in from Calgary with a question. Hi, Andy.
Hello, and hello to the both of you, and thank you for taking my call. Larry, I wanted to know about the company General Mills, ticker symbol GIS. Given our current market conditions, should they continue in this direction, or would you rather play the same sector with something like a Kraft Heinz or a ConAgra? I'm just going to hang up and listen to what you have to say about General Mills. Thank you so much.
Okay, thanks for that. Larry?
Yeah, and these are all names that we use in our portfolios for clients. And right now, a case where we talked about dislocations, rising prices in the food prep services industry is strong right now. These are being unduly hit because of that. Fertilizer, as an example, is one of the input costs into General Mills that makes cereals, by and large. So I like them all. I think they're cheapening up considerably. And in almost every case are really good dividend payers. So I like the sectors. Overall, it's being dislocated, and I'd be adding to it here, again, with the view that these are temporary dislocations, and you want to take advantage of that.
All right, good to know. We've got another caller. Tom is calling in from Red Deer, Alberta with a question. Hi, Tom.
Hi. I'd like Larry's opinion on Kraft Heinz, if I could.
Okay, thanks for that. Short and sweet. Kraft Heinz, similar to the last one.
Similar story. They're not cereals, but again, it's food. We all need to eat. We're all going to likely eat more as price pressures come at home. Kraft will benefit from that. So again, really like the idea of some of these names here that have been, I would say, not unfairly beaten up for a cause, but beaten up and offer good yield and really good entry location for what might be a multi-year hold here.
Okay, we've got another caller. This is Eldon calling in from Powell River, BC with a question. Hi, Eldon.
Yeah, good afternoon. Thank you for taking my call. Larry, I'm recently retired, so I'm looking for an ETF that pays maybe a 7 to 9% yield, low to medium risk, with still a possibility of some growth. Can you give me a recommendation or two? Thank you very much.
Okay, thank you.
Yeah, I like the covered call strategies. In the case of the ZWU that I mentioned before, again, very tax efficient, 7% plus, pretty well diversified, although you're concentrated within three sectors: pipelines, utilities, telcos. It's pretty well diversified. It's 70% Canadian exposure, 30% US. So I like something like that. You can't ever go wrong with the banks in Canada, although I think the risk is a little high from an economic cycle perspective that you want to put a lot of new money in banks, but a ZWB does really well in the BMO world in terms of generating maybe not 7, 8, or 9, but something closer to 6, maybe 6.5 in exposure to the Canadian banks. So have a look at the suite in its entirety of BMO covered call ETFs, but Hamilton does a great job with covered call strategies. There's several others There's a lot of tax efficiency involved in getting the covered call income out of foreign securities. So that's probably where you want to concentrate, because you do get upside capital appreciation and you get a higher current yield, which sounds like what you're looking for.
Okay, Richard is calling in now from Toronto with a question for you. Larry, hi, Richard.
Hello, thanks for taking my call. I wanted to ask about Shopify. I know that their earnings performance has been pretty good, but the stock performance, not so much.
Okay, thanks for that question. It seems a couple of companies are going through this right now where the stock performance doesn't reflect the earnings. What do you think?
Well, I'll say this. Shopify is not, a SaaS company. A lot of the software type names and tech names in general are struggling at the moment. And so, when a stock trades at a very, very high multiple, which is, I would classify Shopify in that period, and you go through a difficult market environment like we're going in now, stock like this is going to underperform dramatically. It presents a buying opportunity at some point. I don't think we're there yet. In the 80 zone for Shopify, that would be an area where I'd start to get, more interested in it. But like we saw in 2022 into 2023, these things can play out in sort of correction mode for an extended period of time before the trend goes higher again. So it's been trending up. It's correcting now. I think there's some more downside risk. I like it better in the 80 zone than I like it here at 110.
All right, I think we have time for one last caller. Luis is calling in from Toronto. Hi there, what's your question?
Hi, Lindsay and Larry. Thank you for taking my call. My question is, would you hold on to a position in Global Active Preferred Shares ETF, ticker HPR, with all the uncertainty in the markets, or is it a good time to sell it?
Okay, thanks for that. Larry?
Yeah, there's the biggest factor on prefs is what's going on with interest rates. A lot of the weakness in the last, call it month, is more related to yields pushing higher than it is anything credit wise you would have to worry about generally in pref securities. So, HPR is an okay way to get that sort of tax efficient income into your portfolio. So I have no issues with that. I wouldn't run out and sell it. I don't think the current market environment, we have to worry too much about the pref market.
Okay, we're going to take a quick break right now. Coming up, though, today's educational segment with Larry Berman. That's right after this break. Stay with us.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. We are here with Larry Berman, and it's time now for Larry's educational segment. So, Larry, today, talking about how do you know when a correction is over?
Yeah, Lindsay, one of the biggest questions that come at a time of market volatility is, when do I put new money to work? And the answer is, it really depends on how risk-seeking or risk-averse you are, what your frequency of trading is, and then when is that opportunity? So a couple charts to share with viewers today and give some insights at least into how I think about it, so that hopefully you can make a good decision on this. Now, the Berman's Call Pro Eyes indicator series, this is something that we put up on the internet for BNN viewers to watch many years ago, and currently is flashing by way of technical oversold conditions. So there's multiple components here, and if we can bring up the first chart. This looks at 12 different technical indicators, and it just does an equal weighted approach to see how statistically overbought or oversold they are. When the indicators in the red were cautionary, so for most of the last number of months, we've been in a cautionary environment with decay in terms of market momentum, and that's that indicator starting to go from red to orange. Now, with the recent sell-off, it's starting to go into the green. Green is a zone of opportunity, and you generally want to flip from being a seller of strength to a buyer of weakness. Question is, we don't know how low it's going to go, and I wish I did, because if I knew where markets were going to bottom every time, I would have all the money, and I don't. But this is an type of indicator to help us know when. Now, we never know if it's going to be a bottom like 2022, where it's very choppy and it takes a long period of time. Typically, those are Fed tightening cycles, or is it going to be more acute, which is event-driven? Think COVID in 2020. Think tariff tantrum from Trump in 2025, where it was more of a down and up. So this one is more likely to be somewhere in the middle, because measured in months of uncertainty, but more likely a down and an up, as opposed to something that's going to go over quarters and quarters and quarters. That's more long measured. And so that's kind of what we're thinking here. Now, if we look at where we're going to go, one of the things technical guys like to look at is retracements. And if we bring up the next chart, and we look at that red line at the top, analysts believe that that's where 1 year forward market multiple is likely to be in terms of price targets. So wow, potentially a lot of upside. I'm really surprised that they're continuing to upgrade the earnings forecast looking out a year. But we look at the technical retracements, the 50% retracement at around 5,900 is something that when we look at the rally over the last year, or the rally from the lows in 2022, that 5,900, 5,650 area really stands out in terms of where we might see this market correct into. It's going to really depend on how long it takes. Final chart here is a look at the fundamentals. We can look at historically what the forward price earnings ratio was at other market bottoms. Historically, going back 25 years, that's 17.5 times earnings. More recently, it's in the upper part between 17.5 and 19 or 20. So we're getting into that zone both fundamentally and technically of where the markets are oversold. We're not there yet.
Okay, we will leave it there. Larry, thanks so much for that. And if you'd like to follow Larry online, you've got options from YouTube to LinkedIn. And that's it for today's show. You can join us for Berman's Call Monday at 3 p.m. Eastern, 12 noon Pacific. The close is coming up next.